Hello, can everyone hear me? Good, welcome. I'm Arash Massoudi, and I'm thrilled to be here with three leaders from three distinct geographies, which I would have said were close allies until, the last 6 months has raised some doubts about that. But we are going to explore some really interesting topics, which I think Dominique and Ken have both teed up about how the investment landscape has changed. And I think these guys represent a very unique situation where they're trying to provide over a very long term for their customers, who in many cases are employees who have contributed to retirement programs, and they have a very unique set of challenges to hit the returns they need to hit, and they sit at the front line of navigating all these trends with which people like Dominique and Ken are often trading in and out of much more rapidly. So I'm thrilled to be here with all three of you guys. Quickly to introduce, this is Kourtney Gibson, all the way to my right. She's the CEO of Retirement Solutions at TIAA, overseeing retirement strategy for millions of participants in thousands of institutions across the US system. It is truly a gigantic company in the retirement space. Peter Mørch, to her left, is CEO of PensionDanmark, a former senior civil servant in the Danish government, and now runs one of Denmark's largest labor market pension funds, which has a strong focus on infrastructure and strategically important technologies. Welcome, Peter. And Peter L., for the purposes of this panel, is president and CEO of OPTrust, one of Canada's leading defined benefit pension plans, serving over 100,000 pensioners, and is known for its long-term discipline in investing. So, Peter M., if I could start with you. Give me a sense, in particular, Denmark and to some extent Canada have had a very interesting 12 months since President Trump came into office. Can you give me a sense of sort of how the outlook of the fund and the mandate and the way you guys look at investing has changed over the last 12 months? And if you want to take a longer view of 12 to 24 months, that's fine as well.
Yeah, so 12 months is adequate because we're almost 12 months since the administration was changed in the US, and I would say that is the most defining thing that happened to us over the last 12 months or the last year, because it has really changed a lot in our thinking about the investment portfolio. We are heavily invested in the US, we still are, but in the middle of the year we changed some of it. We rebalanced our equity portfolio, 10% of it back to Europe, and we did that under the impression of increasing uncertainty about the investment environment in the US. It was about the taxes and the big beautiful bill. It was the uncertainty about tariffs, possible trade war, and also we did it because we want to be responsible investors in the environment we're from, and that until recently had a lot to do with the climate change, investing in renewable energy, and now it's a broader picture, and we see ourselves also as responsible investors when we try to also take part in the build-up of Europe's capacities. So the major change to us is that signals from the US is that Europe should stand more on its own. Europe is, in security-wise, possibly home alone, and we're not fit to take that up as it is now. So we're looking to, with our investment muscles, also to strengthen Europe.
Can I just digging in a bit on that? It is kind of conventional wisdom that the broadest set of investment opportunities are in the US. And when you look at global investors, the US is such a focal point. When you're making the decision to reallocate away from the US with this 10%, how do you think about hitting your investment targets and continuing to fulfill sort of the needs of the returns when you're shifting away from a market where you presumably were there because you thought that generated the highest returns?
So decisions like that would also always be returns first. And at that time, we had a positive evaluation on the new Commission's plans to follow up on the Draghi report. We also had the new incoming government in Germany with a massive investment plan. And we see that European companies are valuated much lower compared to American companies. So there is a potential there. So we would never make such a shift just to support Europe. It will always be an evaluation of return potential.
And based on where you are now, looking forward into next year, then are you happy with the positioning that you guys have done?
Yeah, so far it's been quite neutral. We didn't win on that. We won a lot on increasing our equities in the defense sector. That was another strategic position we made at the same time, and that was great. But the shift from U.S. equities to European equities has been neutral since then, and it's a longer view we're taking. And if our evaluation on the potential changes, we might go the other way again. But for now, we're holding it.
And Peter L., coming to you, I mean, do you want to take on the same question? How has the investment outlook shifted over the course of the years?
Yeah. So first, I think we took much less of a change. We tend to think of ourselves as long-term investors. Hopefully, the next administration will be finite in terms of the tenure and the approach that's being taken. I believe it's mostly negotiating tactics. However, we had the same concerns around the tax situation in the One Big Beautiful Bill. We did our own analysis on that, so that's worrying. So what that means for us is, with our incremental dollar that we want to do, it just raises the bar of the challenge to invest in the United States. It doesn't mean we will not do it. In fact, we've actually added net more assets into the US in the last 18 months. At the same time, though, we've found there's a higher likelihood expected for inflation to be higher for longer. And that's something that's particularly damaging for a mature pension plan like ours. And so we increased our gold allocation significantly over the last 18 months. And that paid off extremely handsomely, for example. Other examples of things we've done have been changing our hedge ratio on our fixed income portfolio, which is our liability hedging portfolio. We don't hedge 100%, but we hedge sort of between 20 and 40%. So that's another thing that we've changed as we changed duration, and we changed whether we hedge in. Sometimes we hedge in U.S. Treasuries and sometimes in Canadian Treasuries. So we've taken some different choices there. So interest rate sensitivity, gold reallocation. But we're actually very positive on risk on at the moment in terms of how we think about the markets. And so we are at the higher end of our risk allocation when we look at our potential for allocating.
And just, you've obviously also had a change of administration in Canada. Mark Carney is now in charge. He's asking for people to do more to help grow Canada. How do you sort of evaluate the investment opportunities in Canada as a major focal point of this conference as well? How do you sort of see the landscape? Is there enough to do with a fund of your size there?
Yeah, but it's not just Canada though, right? We hear the same thing from European opportunities as well. So we're going to go where we feel the best investment opportunities are, and we're going to allocate in the things that are right sized, the right level of risk for our pension plan. A number of the large nation-building type projects that's being talked about there are frankly very, very large. And if we were to participate in that, it would be a very small fraction. And that's not the way we approach infrastructure and private equity. We like to have a significant stake in the companies that we own or invest in so that we can actively manage them. We want to have a say on how those firms are operated. So it would be quite challenging for us to operate directly in the larger projects. However, as we work with the provincial government in Ontario and with the federal government, maybe less so, but more with the provincial government, they have interests to do real estate building in Ontario because, like in a lot of countries, demand has outstripped supply, so prices have gone up significantly, which has created problems. And they want to build more hospitals, they want more doctors. So we're trying to work with the agenda more of the provincial government than the federal government because that's probably more right-sized for a fund of our size. Plus, we're based in Ontario, so we like to invest
in Ontario.
Yeah.
Kourtney, if I may come to you, how has all the events of this year, which have been vast, and we've heard a lot about them already today, how do you see that reflected in sort of retiree behavior, investor behavior through TIAA?
Well, first of all, thank you so much. It's a pleasure to be here with such an esteemed panel and to be welcomed in a country that is just absolutely fantastic. So I have to absolutely provide my gratitude for the welcoming that I've received here in France. You know, TIAA, for those that aren't familiar with TIAA, is actually an insurance company that was founded for one reason and one reason only, and that was to provide retirement security for teachers, doctors, policemen, firefighters, serving those who serve others. And so we have about $1 trillion in retirement assets. And then we also own Nuveen, which operates globally for us and has, between the two of us, just shy of about $2 trillion in assets. And so when we think about what's been happening, you know, not a lot's gone on this year, right? But when you think about everything from workforce shortages to now, I think the U.S. just came out and our unemployment rate has gone up a couple of ticks. You think about tariffs, you think about executive orders in the United States, that uncertainty created a tremendous amount of fear, candidly, in the minds of retirees. And when we think about how many of the baby boomers, I think it's something like 10,000 retirees or boomers are retiring, turning 65 every single day, that's huge. And if you were getting ready to retire in March or April of this year, you had some concerns. And you had concerns because you watched your portfolios fall. So unlike a lot of places across Europe, and even in Canada, where you have a secure retirement, our defined contribution market, a lot of it is left to right now market volatility. And so a lot of people, and candidly, the system itself has been geared towards the accumulation phase and saving a lot of money. What we forget is why we save. And you save so that you have income in retirement that you cannot outlive. And so to our participants, which are about 5 million or so across 15,000 institutions, we were answering a lot of calls. Our call centers were flooded. Our advice and planners were flooded. What we saw was a tremendous flight to quality. And so our annuity, which actually guarantees lifetime income, we saw a tremendous amount of people saying, look, I just don't want to lose my money, which sounds like it makes a lot of sense when you think about it. And so we, wanted people to keep calm and as appropriate relative to where they were in their life cycle of working, staying allocated, because over time, markets are resilient. And so it was really giving a lot of confidence into the people that we serve to say, hey, what are your objectives? Are you properly allocated in your portfolio? And if you aren't, how can we help you to get there? And what are you thinking about as it relates to asset allocation and your income in retirement? In the U.S., again, we have a tremendous amount of people that are allocated to target date funds, which essentially lines up where you think, if you think you're going to retire in 30 years, it's lined up to that. But one thing that's been missing up until more recently has been guaranteed income as a part of that. And we call it the target date 2.0, where now we're saying, okay, you have allocation to equities. You have an allocation to fixed income. You have an allocation to alternatives. Where is that guaranteed portion that you know you will not outlive? And so we've been very focused on that, and it's been a significant growth engine in the United States and really building in that guaranteed lifetime income as a part of these portfolios. Because the markets, one thing they're going to do, they're going to go up and down. And so as you're invested, how do you make sure if you're 70, like my father was, getting ready to retire at the beginning of this year, that a portion of that portfolio was guaranteed? And so that's where we've spent a ton of our time and ensuring that we can live out our mission, which is, returning our profits back to the people that we serve.
And can I just drill in on this point around the kind of the tariff crash when the stock market went down in April? Did you guys see a significant amount of retirees pulling all their money out of the things they were invested in and then stayed in cash and missed the return rally? Or how do you kind of navigate that? Because with hindsight, the best thing to do was to not touch anything, right?
And we advised people of that, and we actually didn't see a significant uptick in withdrawals, which is a fantastic thing because, again, retirement is meant for the long term, so we did not see that. Like I said, what we saw was a shift into more protection in the portfolio, but again, appropriate depending on who you were talking to. So if Peter's getting ready to retire and he was in 100% equities, that was not a pleasant time. And so we advised Peter what his allocation based upon what he wanted to achieve in retirement should look like. And we actually saw the largest inflows into more protected asset classes than we saw since the pandemic. And so it gave us there's nothing like, you don't want to waste a crisis, I think is what we were talking about previously. And so during this time, if that caused participants or our clients to call in to say, hey, what's going on with my money, that's a good thing. Because there isn't anyone kind of overseeing it to say, hey, Peter, you got 100% in equities. Do you mean to be there? You know, you're 70, you're not 70, but you're 70 years old. Like, is this really where you want your money right now based upon your objectives in retirement? And so I think it was a fantastic, chaotic for my team, but it was a fantastic way for us to truly, day in and day out, live our mission of our company, which is getting people more secure in retirement.
And maybe just, this is another curiosity of mine. You obviously in the US, the defined contribution system, every month, a huge amount of money gets allocated, I presume, to the stock market generally. Do you guys have a sense at TIAA the amount to which that is backing up valuations when this wall of money comes in every month into the equity markets? Is that a key driver of valuations as well in the market? And if that stopped, would it affect valuations?
Well, yes, a lot of the pension systems have a large portion in indexed assets, which again align a lot of times to these target date funds within the defined contribution market. And so do I think that's backing up valuations? Maybe, but you also have a lot of active managers that are making stock selections. And I think this is a year where, you know, if you were a good stock picker, you're outperforming the market. And so I think we're coming into a season, and we're probably already in the midst of it, where rising tides are not lifting all boats. And so whether that's in equities, whether that's in bonds, or even in alternative asset classes. So they were just talking about private credit. That's another place where, you know, all things aren't bad. You see the headlines, but that's where it's critically important to be clear on who's managing those assets. What does that diligence process look like around both, whether it's equity, private equity, or whether it's on the credit side? How are you evaluating that credit? What do the covenants look like? And how are you delineating between companies to ensure that the risk that you believe you're taking is the risk you're taking, and then the commensurate returns are to follow? So I think it's very much a time now where people are focused on having asset management professionals managing those portfolios. And again, for us, and as well as for all of you having a long-term time horizon, being able to say, based upon where we're going, we're going to stick to our knitting, we believe in our process, and following that through.
And maybe just a quick mini question for the two Peters, given they run pension funds in Canada and Denmark. How are you guys stress testing your portfolios? And does the way you stress test your portfolios for economic and political shocks, has that shifted at all? I mean, I assume there must be exercises you do, but are you doing more of those than you were before? Or can you give us a sense of sort of how you test your portfolio?
Yeah, so we do it quite regularly. I'm not sure.
Here, Peter, friend.
Yeah.
Got it? You're good.
You got it now, yeah. So we do it quite regularly. I'm actually not sure if it was less in the past. I'm not. I don't think so. But so what we do is that we make scenario stress tests, like testing how stocks fell at the financial crisis, COVID crisis, and other previous situations, and then we look at the different age categories. So we have a life cycle product where we have decreasing risk with age. So the younger savers with us up to the age of around 50 would have like 2/3 in stocks. And when you come to close to pension age, it would be only 25%. And then you have more real estate, more bonds, more infrastructure. So what we want to see is how much will the deposit of different age groups fall under different scenarios, and then we test it with our board if they have it in the stomach to actually go through that, because it's important, as you indicated before, that we do not have a panic sellout in a major crisis, because if we do so, we miss the rebound. And that's what we are seriously testing with them. Can you do you have the stomach to look at the younger savers losing 25? It could be 30%, and only if the answer is yes, we can have that portfolio.
Peter?
Sure. So we don't have clients, we have members, and they tend to leave the investment decisions to us, so we're fortunate in that regard. As we think about stress tests, I don't think you can really create a stress test for the political uncertainty that we're facing, because it seems to change by the minute. Whether you got 50% tariffs or 100% tariffs or no % tariffs, So I think that's actually impossible to check. What we did do is our research on things like our exposure to tax rate changes in different countries. So we did some standard analysis, but we do other types of stress testing similar to what Peter does for market conditions, historical ones. The other things we've done is some climate-related stress tests, which are actually really interesting. And we sort of look at different scenarios. And it's kind of interesting, actually, since I've been here today, I've heard people talk about climate an awful lot less than at previous conferences. And it seems to be further down the list of concerns or priorities these days, but it's still something that's very top of mind for us. So we think about how our portfolio will perform in different climate scenarios out there over the long term, because we could have somebody join our pension plan at the age of 20 and still be collecting their pension at the age of 100. Mm-hmm. And so they're going to be with us for 80 years. So we think about that really super long commitment we have. And there's no doubt, however, no doubt in my mind at least, that in the long term there is going to be some changes due to climate, whether that's slower or faster, and how that's going to be affecting things. It's physical and transition risk that we always look at. So we do some modeling on that, which is quite interesting. But we're a very mature pension plan, and so we actually have we pay out a lot more every year than we receive in contributions. So we're in a negative cash flow position. We've also actually double the benefits that paid out than we get in contributions. So 70 to 75% of every dollar that we pay out in benefits is earned through our investment portfolio. So we have to be really looking at our risk-return profile. So we are very concerned about that, and that's how we create our portfolio and we think about the risks in there.
Kourtney, I wanted to change unless you wanted to come in on this, I wanted to change the topic to private markets, because there's been a huge change with the potential that 401k contributions could potentially go to private assets. How big a shift is this going to be in the retirement product for millions of people in the US? And how do you go about navigating the risks that also brings to the table?
Well, that is a conversation that's definitely alive and well, given the executive orders. And so in addition to private markets, guaranteed asset classes were added as well. It's interesting because our participants have actually had access to alternatives via our general account for a very long time. But why that's important, it's not just because that's our company and how we choose to invest. It's garnering that access via institutionally managed portfolios. And I think there is a benefit, not that people need to be protected, but sometimes you need to be protected. There's a reason why you're a licensed professional in the industry managing those asset classes. And so I think what you're going to see and what's going to need to happen is a lot of rigor. You have consultants that are very, very heavy in our industry, investment consultants that dictate what funds go on the menus, dictate what goes in those target date portfolios. And I think that's going to be critically important, because one thing the U.S. is a very litigious society, and sometimes that fear of litigation also drives a fear of movement. So do I believe alternatives should be a part of a diversified portfolio? Absolutely, and our participants have it, but they have it within kind of a wrapper of our annuity today, and I think other strategies should be included, but at the institutional level, such that then you have those experts being able to vet those underlying funds. I mean, I'm sure, as you all know, as institutional investors, it's hard enough. And let alone having a teacher or someone whose day job is not doing this, being responsible and accountable for selecting those funds in their portfolio. We might think we want that access and ability, but data shows us that people even today are not selecting the underlying portfolios in their portfolio, and they're publicly traded. So 84% of our participant base is defaulting into target date funds, right? So think about that for a second. Yet we're talking about them actually having the ability to select private markets within their portfolio. I think there's still a lot of opportunity. Again, I'm a proponent, but within the right structure to ensure that we do not have a situation where we're increasing the retirement crisis that exists in America, that we're helping to solve it instead.
No, that's a super good point. And exactly, if people don't know what they're investing in and start going deep on these things, you could see how these could escalate and become a sort of broader problem. I would say it seems like the volume of advertising has really picked up, and none of this has been introduced really in a scale way. But I feel like if you're watching TV in the U.S., you see a lot of advertisement trying to kind of gear the consumer into this, and it's not really teaching them the nuance of it. So it sounds like you guys have a big project ahead of you over the next few years. I mean, one follow-up. How do you guys have the leverage to sort of align the fund structures that the big private capital firms are providing into the plans? How do you align those to be favorable or neutral to the customer, as it were?
Leverage in what way?
Leverage in the relationship, because they're obviously creating the products, but do you have abilities to sort of tell them this is what will work and what won't work?
Yeah, so again, in the U.S., which is, I think, a very good thing, consultants exist. And so you have fiduciaries helping with the plan sponsor fiduciaries to select the investments that go on that menu. So given that we have 100-year relationships with a lot of our clients, yes, they look to us, and we have an alignment of interest, whereas we give our profits back to the people we serve. So when you can create that alignment, you kind of probably trust the person sitting there. But more broadly, those consultants are the ones that are helping those plan sponsors select what goes into these asset allocations. And what we're seeing so far, even in the consulting community, is that they are vigorously evaluating them. Most of them they already know because they're using them in endowments and foundations and other separately managed accounts, but they are vigorously evaluating them. But they're hesitant to be kind of first movers, hence why you really have not seen that movement yet. So again, I think there's a lot of diligence that needs to occur. The structures, how you adjust the target date fund series to include alternatives as a standalone asset class. There's a lot more work to be done there. So it's I don't want to say it's all hype and no action, but right now we'll say it's a lot of diligence, and we'll see what kind of happens in the next probably 3 to 5 years in the space.
Thank you for that. And coming to the Peters, and maybe we'll start with Peter L. this time. How have you guys gone about navigating the past 4 years in private equity where the vintages of 2021 have been more challenged and not returned at the same levels that prior vintages? Has that changed the outlook you guys have when you're making private equity allocations? Is it now a better time to go deeper because people are more skeptical and they'll have to work harder in the next round of deals? Or how are you guys approaching your private equity performance?
It's very interesting. You know, people are very short-term memories and focuses. I feel like we're in a period now in some of the private asset classes, and particularly, you know, private equity infrastructure, and more so even in real estate, of less liquidity, right? Now, these asset classes are called illiquid asset classes for a reason. And I think what we've seen actually over the last 5 to 10 years has been very liquid, illiquid asset classes because they've been extremely well sought after and going on. I think this more recent period is more of a normal part of the cycle. We had incredible valuation explosions in the private markets for so long. 2021, 22 valuations were up significantly. And that, I think we've paid that forward, right? And so now we are seeing slower increases or decreases in some cases in these private asset classes. But I do think it's just part of a normal, much more normal cycle, actually. And I think part of it was in interest rate exposures. Obviously, post-COVID, we had the inflation shock. I think that created a problem. The response from central banks to raise interest rates, that created some problems, and getting financing was obviously a challenge for the newer expansion of asset classes. So I think it's just actually part of a normal cycle. If I look at our portfolio, we have 45, we target 45% in our private equity infrastructure and real estate portfolio. We do the majority of that in-house. That's
45% of the overall.
Of the total plan is in-house. And it's generated 3/4 of the returns of the fund over the last 10 years. So, you know, less than half of the fund has created 3/4 of the returns of the fund. So the value of having access to those asset classes for our members, who are typically on the lower end of the salary scale, frankly, so the democratization of private assets, it happens in the defined benefit space where we are, in the Canadian model especially, where we have high allocations to it. I'm really happy to hear that it's democratization in the general account as well. So it's good that other, you know, more normal people have access to these type of asset classes. So it's really interesting.
And Peter, how about you?
Yeah, actually quite similar answer to the other Peter here. So we see the private asset classes as something that really adds stability and diversity to our portfolio, and we take a long-term perspective on it. So we're not changing the overall allocation in this. Quite similar numbers also. We have around 20% of our AUM in private equity, 10% infrastructure, 10% real estate. So in total about 40% there. And in a long perspective, we're happy with returns. They can match the listed market and also give an illiquidity premium when it comes to private equity and infrastructure and real estate is. We consider very secure asset classes that give a premium compared to bonds, and they have been also important parts of the portfolio where we can take a particular societal responsibility in our investment policies. So we have a lot of infrastructure in renewable energy, and some years ago we were founding partner of Copenhagen Infrastructure Partners that has now developed into the largest offshore wind energy producer in the world. So that have given us very satisfying returns.
Yeah, Kourtney, please.
I was just going to add on, I think the biggest difference, right, and to the question that you asked me about, seeing alternatives going into retirement plans on the DC side versus what these gentlemen were speaking of, that illiquid asset class, as you appropriately pointed out, is what helps to create the returns. When you can invest something for 10 years with maybe 2 one-year extensions on the back end, you have the ability to generate these outsized returns. What's happening, though, and in today's world, the way that policy is written on the DC programs and consultants want, you have to have liquidity. And so having an illiquid asset class as a part of a retirement plan where you now have to have liquidity whenever someone wants to withdraw is problematic. If you were to say, hey, how do we make sure that people are actually saving it for retirement? You put a lock-up period on there and you say, okay, this is for retirement. I think you'd get I'd be much more comfortable with that as a part of the new wave of alternatives being in these programs, because they're not meant to be traded like stocks, right? When you have a private equity or private credit or real estate deal, you're not investing it with the thought that you're going to return that money tomorrow. And I think that's what's going to be an interesting nuance as we look at how these come into the defined contribution markets in the States today.
And if the retirement investors understand the illiquidity premium they need to be paying for?
Well, and they won't be, though. So what's happening is, because of the way ERISA laws are written, I mean, you have to have, in order for it to be a qualified investment default solution, you have to be able to provide liquidity at the participant level. So if you want to withdraw your money, even though you selected, to be invested in a private credit fund, I have to give you that money back in order for it to be qualified in the default. And so that, I think, alone, because you can't get alternative-like returns with having, equity liquidity and public market equity liquidity. And that's what I think is also misunderstood today. And some funds right now are saying we can provide you daily liquidity. Okay, great. Let's see how that kind of works out long-term from an investment perspective. So that's why I also said stay tuned. But being able to be a long-term investor in this space, I mean, the outcomes that have been able to be achieved, hence why you guys are so fully funded. I think, Peter, you told me 120+% funded. A lot of that is obviously due to your ability to have a diversified portfolio in illiquid asset classes.
One of the things, changing gears to the climate, which you touched on already and which Peter M. has also brought up, it's very interesting around climate change discussions that often, while we've noticed a real decline in sort of political leaders and corporations talking about it, it's interesting that when you talk to investors, it's still something that investors think very carefully about. And I was wondering to what extent how you navigate that with your various organizations as the kind of political atmosphere around it has changed materially around climate-related investing, sustainable investing, energy transition investing. How do you kind of keep those things front of mind in a world where the political atmosphere has shifted so rapidly?
I can go first because Canada really hasn't shifted as much as maybe the United States. But I mean, even people I know in the United States, they still think about it, because when you're thinking of building a power plant or you're building a new building or something like that, you're going to do part of your due diligence as where am I going to build that, right? And so there are certain parts of the United States where insurance rates have gone through the roof, for example. You know that it's probably not the best. The insurance companies know, because they do a lot of this research. You do your own research. That's probably not the best place to build a building. So we think about it from the climate physical risk perspective. When we're investing when we're looking at different investments, whether, in the public or the private space, we look at it through the lens of, okay, is there any incremental transition risk that we expect to experience in this investment? So we're just very climate aware as we think about it. And we're also looking at changes to, like I said, we do analysis of, under different scenarios of whether or not it's 1.5 degrees or 2.5 degrees or whatever, we think, some of those and how those things could change with time. So we're very, very climate aware in our investing. It's not the only thing that we look at, but it's a big one.
And Peter, I mean, obviously there's also been a big story this year with several big energy transition companies in the Nordics struggling quite a bit. So how have you guys managed that?
Yeah, so again, we take a long-term perspective on this, and obviously climate change is not something that is over. It's a long-term trend the world will have to deal with. So we're quite confident that it will be back in focus. Having said that, it's interesting how the drive for investments in renewable energy these years have changed to geopolitical matters and indeed energy pricing. And if you look to Europe, there's aggressive plans to build out renewable energy from wind and solar, batteries, and that comes from the geopolitical need to be strategic, independent from energy from outside. No more gas from Russia, and to pursue that, you need to have a full electrification of society, and that's what's going on. And the cheapest electricity you can get if you want to add to the grid is from solar and wind, and therefore we also expect to continue investing quite a lot in the US in renewable energy, although it's definitely not on the political agenda to combat climate change, but it's simply the cheapest new energy, and they need so much electricity for data centers and AI. And also we have a lot of investments in solar panel and batteries in India, South Africa, and again because it's competitive prices.
Kourtney, how are you seeing the sustainability concerns in the retiree space? Have they shifted?
I would say no, they haven't shifted necessarily. And as a member of one of the oldest millennials, don't tell anybody on the screen, but and I also have children who, if you look at longevity and life expectancy, my 7-year-old is expected to live to 106 years old. So I'd like this planet to be here personally, but it's also a good business decision. So to your point, right? I think if we can take the political components out, and if you actually focus on the returns and the inevitable need and demand that's out there, whether it's because of the AI, whether it's because of just population growth, there is a need for new sources of energy on this planet, and they are good investments. Again, it goes back to diligence, it goes back to ensuring that you're making the right investments at the right times, but there is a good investment reason to be there, let alone a good opportunity for us to maybe make sure the planet's here at some point in the future.
Okay, and then coming on to the AI topic, I mean, give us a sense of where you guys are finding the most compelling opportunities to invest, if you are investing alongside the AI trend, and if you're not investing, maybe why you're concerned about it.
I'll go.
Go ahead, yeah.
So we are interested in the AI opportunities. We tend to, I think, like I've heard other people speak today, probably more come at it more tangentially. So the energy production is very important, but we try to find it in a location where there's incentives to provide that energy. where there's a competitive pricing situation, and also where there's government support. So we've done that. We've made investments like that in Canada. We've also have renewable energies as well in Canada and in Europe, again supporting AI demand. The other way we participate is in the real estate space, so in building data centers or locations for data centers. There's a couple of really interesting ones, which is kind of a fun story, and I don't know if it's going to catch on, or I don't know if it's scalable, but in San Jose, in Silicon Valley, there's huge demand for data centers, as you can imagine. But there's real challenges in terms of getting energy there, and there's also challenges with real estate. So we came up with a fairly interesting solution with one of our partners, whereby we can build a data center adjacent to a multi-residential building, and we actually use the heat generated by the data center in a heat engine to power and cool the residential space. So it's actually a net zero data center. And so we did that with the participation of PG&E, so Pacific Gas and Electricity, who are extremely excited about that. So it's kind of so we try to find creative ways to both include
and the return profiles on this look very attractive.
Yeah, absolutely. And I think the biggest challenge with it is making it scalable and big enough, because there's much more demand for data centers maybe than multi-residential in the same location. So it's kind of an interesting thing, but the top technology is simple and easy to implement. So,
Peter M.
Yeah, so when it comes to the big AI players in the listed market, we have a neutral exposure, which is a heavy exposure, and quite worrying. But we're there, and then around AI, also investing in data centers with Copenhagen Infrastructure Partners. We've developed microgrid solutions for large energy off-takers, where you have your own energy production and batteries around it. And in smaller scale, we also venture investing in quantum computer companies. We have a strong community for that in Copenhagen, so we've put some bits in that.
So you guys are doing some venture investing as well?
Yes.
That's fine. And Kourtney, how are you guys deploying AI at TIAA?
Well, we're actually doing it in two ways. So internally, we are really looking at taking a 100-year-old company and say, how do we do what we do so well, powered by this new technology that's come to bear? So we've actually created MyGate, so it's our own kind of chat GPT, if you will, that takes large language models, agentic AI, and says, we have a problem, help us to solve it. And we're doing it everywhere from our call centers all the way through crafting emails to be more empathetic when we have to send a letter to a participant. So we're thinking about every single avenue of our business internally that we can leverage this new technology in order to make us smarter, faster, better, and hopefully deliver more returns back to the participants that we serve. And then our asset manager in Nuveen, who has been doing, I'll use the term ESG, before it was ESG, going on 50 years ago, they're invested in, as we think about ways to fuel this. You talked about PG&E. There's a public market play when you think about the utilities, right? There are tremendous advantages that can get you some accelerated returns in the public markets. You look at the private side and funding, whether it's data centers, whether it's thinking about different renewables across the board. So Nuveen's a kind of public to private asset manager, one of the largest in the world, and they're using the 50 years of innovation to say, how do we do that today and really create outsized returns for our investors? So again, at TIAA, we're doing it internally. And again, it's testing. You might fail on some, but you're gonna get some right. And then it's also externally via the investment of capital that we do.
Okay, we got about 10 minutes and probably 2 more sets of questions for you guys. One of the elephants in the room in this conversation has been the fact that people are living longer, and between defined benefit systems and defined contribution systems, that has different strains on what you guys need to do. Can you give us a sense of how that is going, what challenges that presents, and what you guys are trying to think through?
Thanks. Before I started this job, retiring into poverty was not a words that I'd never heard before, but it's something that has become increasingly a concern, I think, for society. I think it's increasingly a concern should be a concern for all of us. And that the majority of people, the vast majority of people, are already aware that they don't have sufficient savings. And I think the people who think they do just haven't done the math right yet, for the most part. So you need to have a good federal plan, you need to have a good, if preferably a good employer-based plan, and you need to have your own personal savings, is my view, to have even a decent chance of a good quality of life in retirement. And so we do a lot of that work on behalf of our members, and so they have access to a very good defined benefit pension plan, which is based, their maximum earnings and their five best years of earnings. It's based on that, and if they can get, the vast majority of that paid out to them monthly, as long as they live through the defined benefit structure. So it's incredibly important for them. And for the most part, they're some of the lower income people in the province who, without that asset, which is probably the single biggest asset they have, if they knew it, is really, really important. I think both for society and for our members, of course. I think the other thing that's really important, and we've done some analysis on this, is the vast majority, almost 100% of every benefit dollar that we pay to our members gets recycled into the local economy. So they use that money, they recycle it back into the economy. And in fact, there's actually a multiplier effect that we've been able to evaluate of about 40%. So we actually, more money we pay, the better it is for the overall Ontario society as well. So it's a really important part of the pie, in my opinion, for ourselves, for our members, and more people should have access to defined benefit pensions, ideally. And we've tried to expand our pension plan and have made it more available to more people in Ontario, trying to broaden that out to go beyond just the public sector, but the broader public sector and the non-profit networks. And we've created an extra schedule of pension payments, pension benefits that people can invest in Ontario, and we're seeing some good interest in that as well.
That's fascinating. Peter M.?
No, but it's great we live longer, and another great thing is that it doesn't come unexpected to us. We can calculate this, we can make plans, we can design the system to take care of this. And the two things we need to make sure in a society is that people don't retire too early. And the other thing is that they save enough during their working life. And in Denmark, we have indexed the official retirement age to the expected living time, and that means it is every 5 years, currently increased with a year. My own personal expected retiring age is 71, and it's important we don't stop too early if we're about to live until we're 90 or something like that. We cannot be retirees for 30 years. It doesn't work. And then we have the savings system, which is mandatory. So you cannot opt out. You cannot take your money out before retirement age. And you cannot decide to pay in less. So for my members, it's all of them every month 13% of their salary that is paid in. And that makes a sufficient contribution to have no poverty in old age.
Wow. Kourtney, how does it work on the U.S. side of the fence?
Well, it's interesting. So with a lot of our higher ed institutions, they too have an employer contribution that is in the double digits. But on average, in the defined contribution market across 401k plans, which is the larger portion of the market, it's only about 3 to 5% employer contribution. So that makes a substantial difference when you think about the fact that, people probably are not saving enough, which we know there's a savings gap. There's an access gap. We have millions of workers that don't even have access to a workplace plan, let alone the income gap. And I have to just say for a second, when you talk about the defined benefit programs, right, back in the U.S. in like 1975, around 70% of Americans had access to a defined benefit plan. Today, that number is less than 12%. And so TIAA is really trying to step in the gap to have a paycheck that people cannot outlive. Not saying your entire retirement portfolio, but something that covers your basic needs that you can't outlive. Because the calculations, to your point on you can calculate it, no calculation that I've seen today is having people live 3 decades in retirement which is essentially what we're embarking upon as we look at younger generations today. And so how do we ensure that unless the system does change, which, I'm seeing some things in the news just today about how our government might be looking to change it, but until that does happen, how do we ensure that people can live a dignified retirement, do not have a paycheck that they will not outlive, and have some semblance of dignity during their later years in life? And that's where we're focused, and we're going to continue to do that, whether it's directly or via partnerships with others across the globe. But it is a challenge that we've got to solve when you think about 45% of Americans today do not have enough money to live a dignified retirement. They will run out of money in retirement, and that is just not acceptable.
Okay, we've got 5 minutes to go. Maybe just a quick closer. What are you working on right now that makes you the most optimistic in terms of, and excited that you're working on at work and in investing? And what makes you the most cautious going into next year?
I think the exciting things we talked a little bit about was in the private market space, where we have, I think, some really interesting extra participants, coming into the private equity and infrastructure and real estate space hopefully through some of the funds that would be being made available to people. I think that's really exciting. I think the other thing that's really exciting is the massive infrastructure spend. So on the demand side, so both supply and demand here potentially on the private investment side, I think is really interesting and exciting. As we think about trying to navigate that, and we find for our pension plan, we're seeing opportunities in more in the energy space for data centers and so on, really exciting opportunities there. So I think in the private space especially, I'm seeing lots of things that have a lot of interest for us, and a change in the players and the dynamics in there, which I think will be really interesting and create opportunities.
And in terms of what you're most cautious about?
I think geopolitics is, but it's highly unpredictable, so I can't worry about that so much. I think more systematically, one of the worst things for a pension fund is high inflation that's sustained, especially if growth slows down at the same time. That's probably that's the scariest scenario for a pension plan like where we have mandated indexed inflation protection for our members, so we have to pay the inflation regardless. So that's the biggest concern that I have is sustained inflation. And so join the dots, are central banks truly independent? Will they continue to be independent and be able to fight inflation, or will they not? So that's probably a big concern that I have.
Peter M.?
Yeah, infrastructure investments in Europe, and in particular right now in the defense sector. We just last week launched a new buyout fund to invest in defense companies in Europe, with two other pension funds being together with us, the founding LPs for that, and that's been super interesting work to work on that. It's a small part of our portfolio, but it's an example of a new.
There's a lot of innovation going on in Europe.
There's a lot of innovation. Yeah.
We're optimistic about arms. No.
I heard that.
Yeah, optimistic about that as an investment asset class, absolutely. Not too optimistic about Europe moving fast enough on that.
And Kourtney?
Well, I'll pick up on the tail end of that. What I'm most cautious about is our ability to actually move fast enough. We're in a crisis. We've got to move fast. And from an innovation perspective, we have, like I said, created a target date fund that guarantees lifetime income as a part of that target date fund. And we've seen about $100 billion in assets move so far, and that should be about $1 trillion market by 2030. And we've just got to ensure that we stay focused and kind of take egos out of it and tackle this crisis together.
Okay, well, on behalf of Peter L., Peter M., and Kourtney, thank you guys so much for listening. I hope that was interesting, and thank you for having us.
Thank you.